Ugh, Dave Ramsey hates whole life insurance. Hmm, I respectfully disagree. Here's why. Now, me personally, I don't hate any form of insurance, whether that's insurance specifically for mortgage protection. That typically is a term life coverage with living benefit that can range from 10, 15, 20, or 30 year. That works specifically well for that specific target audience, or whether it's a whole life, or whether it's a universal life, or whether it's an index universal life policy. They are specific for each specific case or each specific client. The problem we get into in the financial space is when we try to pigeonhole people into what we want them to do when we want them to do it to fit our narrative. See, the whole buy term, invest the rest was a strategy that came up in the 1980s, 1970s, like around that time. That was when people like great people like A.L. Williams that created Primerica, which is one of the main vanguards of this whole concept, which is buy term invest the rest strategy. That typically meant most people back in the 80s and 90s and 70s were typically getting whole life insurance coverage for themselves. And they're doing that because they're using whole life as a way to fund their retirement as well. A lot of people don't know that. Before the 401k, the 403b, and all those type of retirement strategies got really, really popular. A lot of people back from even the 1920s were using whole life insurance to retire upon. So what they did was they said instead of buying a whole life policy, what they did was they told people to get term policy because the term policy was a little bit cheaper than the whole life policy. So instead of just putting all your eggs in this whole life policy, the concept of buy term invest the rest, what that means is you buy a term policy, then you get some type of stocks, bonds, ETF, mutual funds, fund, or some other investment. And in their mind, what this would do is counteract what whole life or cash value insurance was doing for the last damn near almost century before this strategy even came up. So what they were saying is for people to buy a 10, 15, 20, or 30-year term policy and then push the money that they were going to put into the whole life policy into some type of investment strategy like these. The issue comes up in with this is that a lot of people are only using the insurance for this. When insurance, the main benefit of it, or one of the main benefits of it, excuse me, is the death benefit. Okay, so in the death benefit, a lot of people were signing up for 100, 200, 300, 400k. You were able to sign up for a higher death benefit than you were with whole life. I agree. However, if you look it up, about 97 to 99% of most term policies never pay out. They never pay out because people eventually cancel their policies. They eventually cancel their premiums. Okay, that's just the truth. Okay, so with this buy term invest the rest strategy, the main function of what people were even buying insurance for went away. So the stocks, bonds, ETFs, mutual funds, or some other investment strategy that people were told to put their money into with this strategy, the main function of the insurance went away because most people never had a payout. Okay, because 97 to 99% of them never pay out. Now that's not the insurance company's fault. That's technically on the onus of the consumer, because the consumer stopped paying their premiums, and because they stopped paying their premiums, the policy eventually lapsed. Now, if you were just to compare this with a whole life policy, the whole life policy, when people have it, if they can no longer pay their premiums, they have something called a no lapse premium policy. So that means you have a minimum amount that you can pay on your policy to keep your policy still on the books. And also, if you can't even pay that, if you have the policy for about 2 to 3 years, the money that you built up in the cash value, what happened was the insurance company would send you this money back in the form of a check. Okay, so you get some of the money back that you put in your premiums, and you get it back in a check. Okay, so with this strategy, Most people and most insurance agents aren't even set up to properly put people in stocks, in bonds, in probably ETFs, in probably mutual funds, or some investment strategy. So most people that are sending and giving people in this route actually aren't even set up to actually help them move forward and put in place what they need to make sure that this strategy makes sense for themselves and for their families. So I have no real issue with it. It's just the real issue here is that people aren't set up to actually do it properly and make it make sense for them and their families. Okay. Now, if we just compare it to whole life, or in the modern day index strategy, a lot of people are using this to come back to the old way of what insurance was meant for, which is for retirement. Okay. So they're getting back to the old way of doing things. So getting back to the using insurance, life insurance specifically with cash value for their retirement, for their savings, and for investment strategies, which is what it was meant for. Okay, so most people were getting, whether it's 1%, 2%, 3%, 4%, in some cases maybe like a 4 or 5% return based on their money using these strategies, right? They're getting that. But over here in this strategy, you're getting anywhere from 8 to 15%. Now, if you just have a regular whole life policy, you're getting 6%. You're getting 4% from the insurance company itself, and you get 2% from the dividends that they're giving back to you every single year. So on the low end, you're getting 6%, but in the regular end, you're getting 8 to 15%. Okay, so you're getting the death benefit, which is the important part in buying insurance. Okay, you're getting death benefit, and you're also getting the ability to access cash value. So with these over here, this strategy, most of the death benefit for this never pays out. Okay, and you have over right here a lot of these investments that people are being pushed to. I'm not saying there aren't other investments. A lot of these investments that people are being pushed to aren't actually giving them the returns to even compare to what's over here on this side. So what happened to people back in the 80s and 90s was really, really, really good marketing. And the marketing strategy really worked really well for a lot of people who couldn't necessarily afford the whole life strategy. It worked well for people over here. Now I'm pretty sure there's someone over here in the internet world that has said, yeah, I bought term and invested the rest. Congratulations. You're one of the small few that actually did that. Congratulations, that strategy actually worked for you. But my whole qualm with this is on neither side. My whole situation that I have here is we as fiduciaries need to look at things a little differently. Some things work well for other people, some things don't work well for other people. And we need to look at each person that we help as an individual and not as a concept that we're trying to push upon them, okay? So with that being said, we just showed you why Dave Ramsey hates whole life insurance and why I respectfully disagree.